Okay. Seems right to me. All right, so let's begin with the assignment for leasing. In problem 14, this is our first exciting experience of a t equals 0 lessee and a lessor with a non-zero tax rate. So let's do the analysis first from the perspective of the lessor. And we have a 10% borrowing rate. We have a 35% tax rate. This deals with 8 payments, 100,000 cost, and we're going to have this initially. Well, that's for this problem. It will be in the 5-year class, which has 6 factors. This is one of the places you can make an error pretty easily. And that would be just you have to hand enter one of these incorrectly. And on my exam, I will give you the factors so you can just copy and paste them. So, present value of the factors, very quickly, it's just a matter of what? It's the NPV times the after-tax cost. And all of our values, so we get for that, comma, 4 places, or no comma, I'm sorry, 4 places. Then we get 0.8420, and I multiply that times the $100,000 times the tax rate, and I get the present value of the 1, 2, 3, 4, 5, 6 years of depreciation tax shields. All right, I net that from the cost, leaving the lessor with a net cost of $70,531. I convert that into a after-tax annuity, so I'll say equals payment, and then we'll do 0.065 again, and then the number of periods. This will be a 8-period annuity, and the present value will be this 70,000 number, and then we'll Excel put that at the beginning of the period, and we're done. And this is what I get after tax, so I want to convert that to before tax. So I just divided it by 1 minus t. And that's where I get to 16,733. So it's a $16,900 lease. The lessor could have gone as low as 16,733. The lessee, on the other hand, has a tax rate of 0, and therefore the depreciation tax shields are of no value. And first reminder would be that on your final exam, the lessee will not have a 0 tax rate. So it'll be more like the example that we worked in class. They will have a positive tax rate. And then we just have to find the break even for just simply buying this asset for $100,000 compared to the present value. An equal present value of $100,000 is equivalent to what series of payments? So we just have to convert this $100,000 to a series of payments equals payment. And then the rate will just be 10% because we don't have a positive tax rate. Number of periods will be 8, and the present value will be $100,000. And just remember, you can't put commas in your values for Excel arguments. And then we'll eliminate the, there you go. So the payment is $16,900. This lessee could go as high as 17,000 or 040, and what would you say about that? Well, it would be no worse off than borrowing at 10% and buying the asset for 100,000, the bus for $100,000. So that's what you're breaking even here. You're no worse off than borrowing at 10% and buying the bus for $100,000 than you would be making 8 annual payments, lease payments of 17,040.37. That's all we did. All right. So let's move on to problem number 18. All right, we have the CompuLease company, which is the lessor. We have one more example of a lessee with a tax rate of 0. So let's analyze the lessor first. It's the only one that's particularly interesting. We'll have a tax rate of 35%. We'll have 6 payments, 8% borrowing rate. And this computer system will cost $250,000. Right? So in this case, we have again the 6-year class, 5-year class, forgive me, with 6 factors. And we discount these at 5.2% or 8% times 1 minus 0.35. We'll get 0.8701. I will convert that to a present value of the interest tax yield. So I'll multiply that number times 35% times 250,000. I get 76,136, leaving CompuLease with a net cost of 173,863. Okay, now keep in mind the question in this problem is not the same as it was in question 14. Here we're asking the question, what is the NPV of the lease? So we now have to find the NPV. So we take the 62,000 lease payment and convert it to after tax. So we'll multiply that times 1 minus 0.35, and we see that that's an after tax payment of 40,300. So I did this in a separate step rather than just embedding it in the present value of the after tax payments. And so now I just calculate the equals the NPV, equals the present value, forgive me. And since this is a cash inflow to the lessor, I'm going to flip the sign back to positive because PV will flip it to negative on me. So we're going to use a rate of 5.2%, and we will have 6 payments, and the payment on an after-tax basis is 40,300. Beginning of the period, and we get 213. So net cost 173,863. Present value of the after-tax payments 213. So the NPV is the difference, or 39,954. So the lessor, CompuLease, would be well advised to write this lease. Okay, would the school be better off leasing or borrowing at 8% and buying? Well, here we go. 250,000 is the net savings, which is just the cost because which is the initial savings because there is no adjustment to it for the loss. Excuse me, for the loss of the depreciation tax yields because they're not owners. So anyway, we take the present value of the after-tax lease payment, which for the lessor or lessee is the before-tax payment. There's no difference. So it's 8%, 6 payments, 62,000 each, beginning of the period. We get 309,548, and comparing that to the net savings, if they were to lease, they find out that it has a negative NPV of 59,548. And in the Word document, I asked you not to work Part C, and I'll show you why. It says, what's the net gain from the lease? Well, the lessor gained $39,594. The lessee lost or is worse off by $59,548 by leasing, giving us a net of negative $19,594. Okay, why didn't I ask you to do this? That wasn't terribly difficult, was it? But my concern is, what did I gain from this? What do I know now that I didn't know before I added these NPVs together? Well, what if this number would have come out positive? Does that mean there will be a lease? The answer is no, because obviously, even if, say, the lessee had an NPV of a minus, say, 20,000, well, that makes this thing a positive NPV. But the lessee still wouldn't accept the lease. So I don't know what this tells you, so I even do it. Just extra work for no particular good reason. All right. So what do we know about this lease? We know that the lessee would be better off to borrow at 8% and purchase the computer system for $250,000. That's all we know. All right. Well, let's move to number 19. And this one, excuse me, oh, I got a frog today. I do every day, but that's another world. The Occam Razor Company has tax loss carry forwards, which will leave it for the near future, for the foreseeable future, without tax payments. In other words, the tax rate is 0 effectively. So we have another T equals 0 lessee. So the more interesting of the two parties is clearly the lessor. Let's do that one first. So this time we have 8 factors. And I think you can see that with this methodology, this is not much worse than it would be with what? With the 4 factors of the 3-year class, right? Just have to add these other numbers on before you do your present value calculation. So now I discount these back to their present value at 6.5%. This is my factor. I multiply this times 100,000 times 0.35. I get, if I did it right here, I get 29 or 28,094, leaving the net cost to the lessor of 71,000. And so convert that to an after-tax lease payment. Comes out 11,088 for 8 payments. And then we convert that to a before-tax payment. And so 17,059 or 060 would be the minimum lease payment that this lessor should be willing to accept. And the lessee with the tax rate equal to 0, this is the exact same calculation that you made in problem 14 for the lessee. And so it should come out no different, and it doesn't. So 17,040 is the largest payment that the lessee should be willing to make. And since the largest payment that the lessee should be willing to make is below the minimum payment that the lessor will be willing to accept, we can conclude that there will be no lease. So I hope that's okay. So are there any questions on leasing? Anything I should do again in more detail, more slowly, rework it? Any part of this you'd like to see again? I'd be very happy to do it for you. All right. So what do you have to look forward to relative to leasing? Well, you will have a 10 questions on your final, and you will have a lessee, a lessor. The lessee will not have a zero tax rate. You would be responsible for 3 types of questions, and you already know what those are. The maximum payment the lessee should be willing to make, the minimum payment the lessor should be willing to accept, and the NPV of the lease for either party. If you can do all that, you'll come out of there 10 out of 10. So, we all right on that? Anything I should rework? You fully understand what we just did. Okay, that sounds good. Let's move on then. And we'll move on to mergers. In chapter 19, and I just touched upon it when we did valuation, but one of the methods an acquiring company, in other words, you have an acquiring company and a target company. Well, the acquiring company desires to acquire another company, and they have to determine what's this other company worth to them. What should they pay for it? Okay, and you have many equity capital companies right now who are searching endlessly for good acquisitions. They simply buy companies that are worth it to their shareholders. All right. Well, what's this target worth to them? Do they go through this cash flow to equity methodology? Well, they could, very well could, and there's absolutely nothing wrong with that. But with so many equity capital companies scouring the different markets for possible acquisitions, you can believe that the current price of a company is probably telling us what it's worth. And I saw a nice little quote from some person named Thomas Sowell. I don't know if you follow his writings or not, but he talks about the market and what's it worth to us. So he says, well, the more common choice between decision makers pits the government against the market. In other words, should the government take over this, whatever it is, or should we leave it to the markets? Okay, and he points out that in reality, the market is not an institution. It's nothing more than an option for each individual to choose among existing institutions or to fashion new arrangements suited to his own situation and taste. Market arrangements may differ, but what unites them and separates them from government plans is that those who make decisions experience both their costs and benefits. So, for example, if the government bailed out General Motors, does the government experience the benefit of that? Well, no, the shareholders did, right? Well, they didn't. The bondholders became the shareholders, but you see, on the other hand, if the private market determines what General Motors is worth, well then that's exactly the effect that it will have on the shareholders. You see, their feedback, and it says right here, their feedback mechanisms are therefore instantaneous. So if let's say, he gave another example. What if we see that silver is, or tin, I guess he used the example of tin, is becoming very high priced. Well, then those who are invested in tin will tend to move out of it until the price comes down to what they think it's worth. but that feedback is immediate. They'll just offer a lower price for what they consider, their tin investments. So we can take advantage of the price mechanism to determine or to make decisions in the mergers and acquisitions area. So I have an example in my Word document. All right. And we're simply going to use the information that we were given to evaluate the merger. All right. We're not saying that one of these parties has inside information. So, for example, what if Adams would incorporate Baker into its supply chain, and it would make Adams' supply chain much more efficient? Well, that's not the case here. We're simply taking these as they're worth. A Baker is worth to Adams what it's worth in the open market to anyone else. A week from today, on Tuesday of next week, we will work with a company that believes it can grow a possible acquisition at a higher rate than it's currently growing. So there you will have some kind of synergy. Here, there's no inside information. There's nothing happening except that we will work with just what we have. This is what Baker is worth in the open market, and that's how we'll assume that's the right price for it. All right. So let's highlight these 4 rows. 1, 2, oh, I guess a few more than that. 1, 2, 3, 4, 5, I guess. We'll highlight these 5 rows and drop them into an Excel file. So let's copy these and let's go into here, and you know what? I'm just going to open a new file. The advantage to me of opening a new file, of course, is that when I copy and paste it, I get the font that I prefer. So I'll do that right now. I'll paste this, and I'm going to match the destination format so I can have my font. So this is my default font. I do a Comic Sanskrit Microsoft 14. That's what I always use. You know, and if it's not big enough, I can always blow this up. That's not an issue. And then we can kind of shrink this divider column. All right. So what are we doing here? Well, Adams wants to report $2.50 in earnings per share. And you know what? If these would have kept the format, or maybe I didn't have them in the other document. Let's get some zeros back. There we go. So they'd like to report $2.50. Right now, they will be reporting $2. So if you're reporting $2 and you intend to report $2.50, how do you do it? Well, you can expand via organic growth. That is, you can simply grow your company, or you can grow via acquisitions. So they are going to acquire Baker. Okay, so how will they acquire Baker? Okay, how does a share offer work? So Adams offers so they offer Baker shareholders shares of Adams stock oh goodness, Adams stock in exchange for all Baker shares. If you get to see that. All right. So what happens to these 250,000 shares once this merger occurs? Well, these Baker shareholders will receive shares of Adams. Now, your first look, you might say, wait a minute, Jack. This is pretty impressive to take 150,000 shares and buy these. Well, no. These aren't comparable. But Baker will make a share, or Adams will make a share offer to Baker. And what you'll find if you read 10-Ks is that the number of shares authorized will exceed, at least I haven't seen one that doesn't, will exceed the shares that are outstanding. So the Adams might have done share repurchases in the past, or they simply have more shares authorized than are currently trading. So if you were a shareholder in Adams, so let's say you're a shareholder in Adams prior to this acquisition, to the share offer, well, you have 100, altogether, Adams shareholders have 150,000 shares. Once this merger is complete, they have those exact same shares. So they have their share certificates in their safety deposit box in the at their bank. Well, those are the same shares. They're still there. Nothing changed. However, the value of those shares could very well change. But they keep their same shares. What happens over here? These 250,000 shares no longer will exist. They're gone. I can tell you my experience just in the Eau Claire area. I had companies that I was very familiar with, and they were acquired or merged. Well, they were merged actually, and they merged, and they're no longer here. One of them was this insurance company called St. Paul Companies. And the reason I got to know them fairly well is because they were hiring in the neighborhood of 7 of our finance graduates a year. And so, and they were good positions too, by the way. This was not, you weren't selling insurance. It was a completely different aspect of the St. Paul Companies that they were hiring our graduates for. Well, anyway, they merged with the Travelers Insurance, and now St. Paul Companies doesn't exist. So if you had shares in St. Paul Companies, you now have shares in Travelers. Okay. Let me back up on that one. I don't recall the exact mechanisms by which that merger occurred, but St. Paul Companies no longer exists. It's just part of whatever was there is now part of Travelers. A bank that I knew the manager of the bank in town that was is called Norwest Bank. I got to meet the CEO of that bank, not just in town, but the chain, and they merged with Wells Fargo. Well, there's no longer Norwest Banks. It's now all Wells Fargo. If you had shares in Norwest Bank, you no longer have them. They don't exist. Okay, so, and what's another one? How about Northwest Airlines? On time, comfortable seating, great airline, merged with Delta. Okay, it used to be called Northwest Orient Airlines because they had a incredible relationship with Japan. They had all the Asian countries. I think they were traveling with. Well, now they're part of Delta. So that's why Delta has a major hub in Minneapolis. That's because at one time that was the major hub for Northwest Airlines. And I'm familiar with them because one of my undergraduate assistants took a job with Northwest Airlines right out of undergrad. So yeah, they're gone now, all those 3. Okay, so what will happen here? Adams will make a share offer to Baker. Adams offers Baker shareholders shares. That should be Adams shares. Oh my gosh, how did I do that? Excuse me. Oops, anyway, shares of Adams stock. How do I shift this? How in the world? In exchange for all of the Baker shares. Okay, so in this particular example, if you were a shareholder in Baker, you will now be a shareholder in Adams. These do not exist anymore once the merger is over. But let's do the merger first. How many shares of Adams will you receive? Okay. Okay, what's the goal here? The goal is $2.50 per share. All right. So let's start out with what are our total earnings if this is merged? What's our total earnings? Well, we have 300,000 from Adams. We have 600,000 from Baker. So we would have $900,000 in total earnings, not earnings per share, total earnings. All right, and what's our desired EPS? Our desired earnings per share? Well, it says 250, so let's work with 250. And let's have that zero back, please. Excel. All right, so this implies how many shares do we need? So if you had 900,000 in earnings and you want the outcome to be 250 per share, then we solve for shares. So we'll just say equals this 900 and we'll divide by the 250. So that would imply that the merged company could have as many as 360,000 shares. All right. We will assume that Adams, well, I should say Baker, will hold out for as many shares of Adams as it can possibly receive. And so I think I noted in the document that you have all these equity capital investors, you have analysts who follow certain companies, and then there are other companies who will contact everybody that's following Adams and say, what's your estimate for their earnings? So these different analysts start reporting. One says, oh, 248, the other one says 252, one says 255, one says 250, and next say, well, we have a consensus here. We believe that we're thinking about 250 per share. So they call that the consensus. And what you'll find is that it's very possible that if you have a consensus of 250 and you report something less, your share price can very well go down. If you report something greater than 250, your share price could go up. It all depends on whether or not this below or above, the above you call it a beat. If this either below or above earnings, above the estimate, is expected or unexpected. So, for example, if analysts fully expected that once they get new information, they expect Adams to beat 250, then there'll be no price change for Adams because that was now it's expected. On the other hand, if Adams appears to be in line to report 250, but they report 225, that would more than likely create a share price drop. And if that below consensus earnings report was anticipated, then this price drop would have occurred earlier. So at the announcement, you won't see a price drop because it was probably anticipated earlier than the reported earnings. All right, but anyway, so Baker could probably get a consensus estimate on Adams and determine, oh, I see what they're trying to do, so they're going to hold out. So anyway, one or the other, when you work a problem like this, you can assume that they will pay the maximum number of shares. All right. So this is the total shares. How many shares do we have of Adams? Of let's say current Adams shares. All right. So we have 360 would imply 250 per share. Adams currently has 150,000 shares. So what can they offer to Baker? Well, they can offer up to the difference. You can't eliminate these, right? Those are the current shareholders. You could have authorized, you have to have, in fact, authorized shares of at least 360. So now we'll offer Baker 360 minus 150. So we'll offer 210,000 shares to Baker. All right. So we're going to offer to Baker 210,000 shares. Okay, so now we have the offer. Now there's two types of offers, and you can also see actually many types, but they basically involve either an exchange of stock or cash or other securities or some combination. So for example, you might see an offer that's this much cash and this many shares of, say, preferred stock. That could happen. Or it could be a combination of cash and this many shares, like we're doing here, or it could be just a pure share offer. And what you'll find is that when a company has competing offers, and by the way, if you're holding the shares of either the acquiring company or the target, you want to be the one holding the target because those can get bid up very high in a hurry. But they might take an offer that is technically worth less, but this lower offer could include more cash. So if they're if they value the cash more than they do the total offer, the total value of the offer, then they might choose a lower offer, but with the intent of receiving more cash. All right. And keep in mind now, when you make this, if you accept a share offer, the value of that offer, it depends on the performance of the acquiring company, doesn't it? So you have to believe that its stock will do something, or you might not want to be acquired by that company. Anyway, so this is where we are right now. We will be offering, let's assume that Adams offers 210,000 shares. So this is shares, now keep in mind, shares of Adams stock. So let's see, what do the Baker shareholders do as part of this transaction? They will give up their 250,000 shares of Baker stock in exchange for 210,000 shares of Adams stock. Do we see that? So some people will say, wait a minute, where's the other 40,000? You know, I have 250 here and I'm only getting 210. Well, yeah, but they're not the same shares. You had 250,000 shares of Baker. You were exchanging those for 210,000 shares of Adams. It's not a one-to-one exchange, is it? Right? In fact, that's part of, in your assignment, you have one of the questions is what's the exchange ratio? So offer to Baker, let's see, yeah, shares of Adams stock, and here's Baker shares, and that would be 250,000 shares. What's your exchange ratio? Exchange ratio is equal to, so 210 divided by 250. So it would be 0.84 shares of Adams per share of Baker. So if you owned 100 shares of Baker, what do you now have after this is over? You have 84 shares of Adams, don't you? I mean, if your board of directors approves this acquisition, then you will now have 84 shares of Adams, and your Baker shares are somewhere in cyberspace. They're gone. All right. Whenever you do one of these, our two questions of interest are, what are the wealth effects? How does each party's wealth change as a result of this merger? Well, I hope you can kind of see a red light for the Adams shareholders right now. Well, no, not yet. Let's do our first thing, and let's work on the wealth effects. All right, and the first thing you want to do is, what will the price be post-merger? Okay, so what should the price be when this is all said and done? Now, keep in mind, we're not creating any new value. So whatever value this company has as a standalone company, these companies have as standalone companies, you just combine their value once they're merged. So let's just do that. So let's start out with value merged. Okay, and let me let's put a little colon on the end here just so you know that we're in the process. Okay, we're not going to find it all at once. So let's start with our value merged. Okay, what's our value merged? Well, the current market says that Adams is worth $45 a share times 150,000 shares. So if we merge that with Baker, and Baker is $30 a share times 250,000 shares. So we have a total market value here of 14. Oh, that didn't fit. Let's open this up a little bit. 14,250,000. Okay, and how about the shares merged? So this $14,250,000 of combined value is split amongst how many shares? Well, we just did that. We said we will have 360,000 shares altogether. 150 would be the current or the pre-merger Adams shareholders, and the other 110,000 would go to the former Baker shareholders. All right, so let's work with that number. We'll have 360,000 shares. And so what's the price per share? So it would equal the value divided by the total shares. Okay. Okay, I asked my question prematurely before. And the question would have been, do you see any red flags for either company at this point? You know, what was the two companies? Yeah, well, I see 39.58. That's the price per share. Well, if you were a shareholder in Adams, what did you have before the market? Well, my shares were trading at $45. And once this merger is over, my shares are now trading at 39. All shares of Adams are trading at 39.58. So I've lost something, haven't I? So let's start with the easy one. Let's do the Adams. So we'll do the wealth effects to Adams. The wealth effects to Adams. All right, and pretty straightforward. You've lost, would that be 42? Yeah, about 42. So that would be $5.42 a share, haven't you? So let's just do that. Equals. Your shares are now worth 39.5833 minus what were they before the merger? They were 45. And let's multiply that times the number of shares that you have in Adams. So the current shareholders still have their same 150,000 shares, only they're now worth 39.58 instead of 45. So let's get a nice format for this number. All right. So how did I get that again? I just said equals, this will be pretty close, equals 39.58 minus 45, and that's times their 150,000 shares. That's pretty close, you know, so that's why I didn't want to round this, because that's what happens. But this is pretty much what you did. So I'll just put a little dash there, we can see this. All right, now let's do the wealth effects to Baker. And whenever I do the target, just ask yourself two questions. Didn't they just make an exchange of shares? Okay, and anytime there's an exchange, well, you just gave up something and you received something, didn't you? So let's start out with what they received. What did they receive from Adams? Well, they received 210,000 shares of Adams, and they should trade at 39.58. Okay, so let's get some decimals here if we could. Decimals, commas, I'm sorry. All right, so they received 8,312,500 in value for their shares. What did they give up? What did they give up? They give up all their shares. So they're gonna exchange those 210,000 shares of Adams at 339.58 for what? They will give up their 250,000 shares, which we're trading at $30 a share. So they will be giving up $7.5 million of value. And so if we compare the two, you can see that gain how much? Oh, look at that. What did we see here? So basically, you are seeing what financial analysts will call a transfer of wealth. A transfer of wealth from the current Adams shareholders to the former Baker shareholders. So we didn't create any new wealth here. We just simply transferred wealth. We transferred wealth from the pre-merger Adams shareholders to the pre-merger Baker shareholders, who are now Adams shareholders, aren't they? Okay. So there you go. It's what one gives up, the other receives. Now, another way to gauge this offer, let's see, it'll be sometimes expressed on a per share basis. So let's do the same thing. Okay, hang on a minute. Let's just copy this. Oh, that's good. There we go. So let's bring this back down again. So, oh, that's funny. It fits up there, but not here. How's that work? Oh, did this add zeros to it? Let me see. Oh, what's going on here? Oh, my fault. My fault. I know what happened. Okay, that's on me. There we go. It was a calculation. That's why. My fault. Anyway, they receive 8,312,500. And they receive that for how many shares? Given up what you call tendered, given up for tenure. There you go. And that was for, they received that for their 250,000 shares. So in effect, what did they receive per share? Well, they received $33.25 per share. So what's their gain? Well, you know, they're selling at what? Look up here. They were selling for $30 a share. So their gain is equal to, they received $33.25 per share minus the 30 that they were pre-merger, and then times their number of shares, 250,000. And there you go, same number. They gained 812,500 shares, or $500. All right. All right, let's do some what ifs here. And one what if would be you have some very unhappy Adams shareholders, obviously. And what if in anticipation of this, they said that they pounded on their board of directors and said, don't approve this if we lose even 1 cent. So don't make this offer if we're going to lose anything. All right. So the shareholders, the directors get together and they say, well, we're going to keep our share price at $45 per share. So we will not do this unless we can keep our share price at $45. So let's see what happens. So let's see, the maximum number okay, let's calculate that. What's the maximum amount of shares this company can have merged with Baker such that the price stays at $45 per share? Okay, well, one more time, how much value are we dealing with here? So let's break this down into its parts. Total value. And we have that number. We've done it before. And that would be the 14,250,000. Okay. And the desired price. And we're going to keep this price at $45 per share. All right. So what's the implied number of shares? In order to keep this price at 45, the total shares in the company cannot exceed what? 14.25 million divided by 45 cannot exceed 316,667. All right. All right. So their current shares. Well, they have right now 150,000. Let's make sure that's right. There it is. 150,000 shares. So what can they offer to in order to keep their price at $45 per share? Well, they can have no more than 316,667, and they have 150 right now. So what's the most they can offer to Baker and keep their $45 share price? They can offer them 166,667. All right. All right. So let's say if Baker accepts 166,167 shares of Adams, what are the wealth? So the wealth effects to Adams are obvious, right? 45 pre-merger price, 45 post-merger price, no change. All right. What happens to Baker wealth effects? Baker wealth effect, okay. What do they receive? Well, they will receive 166,667 shares. And the whole goal here was to keep that price at 45. So these shares they receive should be worth $45 per share. So if you don't round, and of course, obviously, if I did 166,667, it would be a little bit different. But yeah, without rounding, they receive $7.5 million in share value. What do they give up? Well, that's pretty obvious. We did that already too. They give up 250,000 shares that was trading at $30 per share. And so they gain nothing from this. So you have to convince them, if we'll be trying this, that they're better off with 166,667 shares of Adams compared to 250,000 shares of Baker. So in the open market, they would be worth the same. All right. So now what happens to that EPS, by the way? So what if Baker accepts 167 shares of Adams? What's the new EPS? Well, here we go again. So how much, what do we have for earnings in total? So let's do this in two steps. Total earnings. So our earnings in total would be Adams 300,000 plus the newly acquired Baker 600,000. And let's do our total shares. We've now authorized and would be trading a total of 316,667. So let's get that number. All right, so what's our earnings per share? Oh, look at that, $2.84 per share. All right, so if they could pull this off, they would have a major beat for Wall Street. And unless some of your analysts that follow the company had anticipated somehow 284, you would likely see a share price increase as a result of this. So that is probably enough for today. On Tuesday, a week from today, we will work with another merger example in which there's actually some amount of value created by the merger. And we will track the wealth effects if the value as expected is created, and what would happen if the value creation that was expected does not occur. All right. And so we will work with both scenarios. We will work in this case, or on Tuesday, we will work with both a cash offer and a share offer. So we'll do all that on Tuesday. So I ask that you enjoy your what's the word? Wellness. Yeah, your wellness day. I'm not sure it's contributed to mine, but I hope it does to yours. So do something that helps your wellness, I hope. So if you would do that, that would be a wonderful thing to do. And I will see you on Tuesday. If you need a little clarification on what we did today, I'll be available in my office hours on Monday. All right. So I will say farewell. I will stay around for any last questions that we might have on this example. All right. So what am I talking about on merger example? Any last minute questions? Oh, all right. Well, I got one positive, it looks like. That's good to hear. I'm pretty sure I did all what I did today is in the Word document. I just wanted to give you a chance to follow how we did it. So it's all there. All right. Well, I guess everybody's leaving. I wish you the best for Thursday. Have a wonderful wellness day, and if not before, I will be in touch on Tuesday, a week from today.